Good afternoon. Good afternoon. It's Monday, the 26th of May. My name is Tilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. And welcome to another edition of Monday Market Picks. Well, it's happening again. Trump has imposed 50% tariffs on the EU, or at least threatened to, and then he's paused it within the same weekend as well. So this sort of back and forth uncertainty is raising its head, and tariffs are back in the minds of investors. Where will this end? We have no idea, but we think that this will drive a lot more safe haven demand for Singapore. And that's something that we're going to be focusing on today in the show, in terms of some stock picks that will benefit from the safe haven demand here in Singapore. So we have economist Brian Lee joining us to take us through the surprisingly good GDP numbers that came out on the first quarter and what's in store for the rest of the year. We also have Jarik's ISOTeam being featured, particularly after general elections. Now that they're over, this can be a stock that will benefit from that. We'll also talk to Eric on LHN, which has had a pretty good run so far, but he thinks there is still more to come. And then we have Husseini joining us to talk to us about Singtel, which has been one of the original safe haven stocks, and also some very interesting alternative data points on Gojek and Grab. And then we also have our chart guy with two trading ideas. So let's start with Brian. Brian, welcome to the show. Now, Singapore's first quarter GDP numbers actually came in pretty strong at 3.9%. What was driving this?
Hi, Dylan. Thanks for having me on the show. First quarter GDP growth surprised us. It was actually stronger than the flash estimate of 3.8%. So what was driving this? Mainly the services component. So services growth actually came in at a rather strong 3.6%, and this was led by trade-related services. So this includes wholesale trade, as well as transport and storage, which grew in a range of 4 to 5%. And this was on the back of, I think, front-loading activities ahead of anticipated tariffs by the US. And also finance and real estate did relatively well. Finance grew 4.5% from a year ago. Real estate grew 7%. And I think this is on the back of the declining interest rate environment that we've been seeing. And also, I think construction was revised higher as well. It grew by 5.5% year on year. Now, this is not really that much of a surprise to us, given that this year there are a lot of construction projects, mega construction projects going on. T5 has already started recently, for instance. Yeah.
Got it. No, but despite all these upgrades, right, the government is taking a pretty cautious view, right? They've kept their forecasts for the year for GDP at 0% to 2%. They've highlighted three downside risks: elevated economic uncertainty, re-escalation of tariff action. I mean, I think we saw that this weekend as well, and disruptions to global disinflation. Yet you've actually raised your GDP forecast for this year to 2.4%. So what's driving this optimism?
I mean, 2.4% full year, that's still much lower than the first quarter GDP growth rate of almost 4%. So we're still anticipating a slowdown, a growth slowdown in the second half, but we are not anticipating a recession or any sharp downturn. Right. So I think there are a few factors, right? So number one, on the trade front, there has been some hope on the US and China reaching a 90-day truce on the tariffs, which will extend into August. So this could actually boost front-loading and trade volumes in second quarter and even into the third quarter. Because of this, second quarter GDP growth may be 3% or higher. And I think on the whole scheme of things, Singapore faces a relatively low baseline tariff of 10%, and it's also trying to negotiate for exemptions on the part of expected pharmaceutical tariffs, which the US may introduce ahead. And I think beyond that, there has been an inflow of safe haven flows into our financial system, and that has actually contributed to a decline in domestic interest rates. Our 3-month SORA has declined by almost 80 basis points since the start of the year, even as the Fed stayed on hold. We think that the declining interest rate environment will help support financial as well as real estate activities. And of course, just to reiterate again, the construction boom is expected to hold up Singapore's domestic activity as well, with the construction of T5 and also the expansion of the 2 integrated resorts. So all these, I think, they underpin our relative optimism on the economy for this year as compared to the official government forecast. Yeah.
Got it. Thanks, Brian. I mean, I think that's something that we also been highlighting a lot. I think Singapore seeing construction that we haven't seen in about 10, 12 years happening right now. There's a lot of domestic spending that is happening. So quite a bit of domestic cycle taking place, which we haven't seen in the past few years. So that actually bolsters Singapore's safe haven status. Thanks, Brian. So with that, I mean, I think we want to look at some safe haven stocks. So let's start with one of the smaller ones, which is ISOTeam. Now, Jarik's got a buy on this stock. Now, to begin with, Singapore's general elections over, and we saw that the government had retained a pretty strong majority. So we now anticipate that a lot of HDB tenders will start to get awarded. Now, this actually creates a pretty favorable environment for ISOTeam, especially given that they will be able to bid for some of these tenders. We are projecting new order wins for the company around 20 to 30 million Sing dollars. They've already got an existing order book of nearly 190 million. So these new orders will strengthen an already strong order book. Now, also on the innovation front, we've seen that they've got proprietary AI drone painting technology, which is set to go into live testing soon. They're the only local operator with this sort of solution. And they actually, if this actually scales up, they can actually save about 40% in terms of costs. So that will directly go into their margins. Now, the advantage is backed by some very strong IP as well. They own a lot of the patents and the works with customized paints that have been developed with Nippon Paints, which is also one of their shareholders. So again, they've got some pretty strong moats here compared to some of the other contractors that are out there. And finally, we actually see that CEO has been buying back shares as well. So there's a lot of insider confidence as well. So Jarik's got a buy rating on this stock. This is one of our conviction buys for this year. And our target price has about 40% upside as well. So do have a look at the more detailed report in our newsletter today. Now with that, let me turn to Eric and let's talk about LHN. Eric, LHN's first half numbers were good, but they were largely within expectations. So let's start there. What were some of the key highlights for LHN?
Hi, Tian. Thanks for having me. For LHN first half results, if we exclude the non-recurring items, the core net profit came in at about 15 million and accounts for about 47% of our full year estimates. This was primarily driven by contribution from the space optimization segment. In particular, its co-living business continued to do well, which was up 15% year on year. The group has also declared an interim dividends per share of 1 cent, in line with its dividend payout ratio policy of distributing at least 30% of its adjusted earnings. And going forward, management remains optimistic on the demand for short-term lodging in Singapore, which should continue to support stable rental and high occupancy rate of above 90% for the rest of 2025.
Okay, so now everything seems to be humming along nicely. So what's going to kind of take the stock higher from here? I mean, what will you need to see for more upgrades in terms of earnings as well as target price?
Yeah, so going forward, LHN has a strong pipeline of projects coming on stream in the second half. It recently launched its new co-living hotel called Kolihu Hotel Kampong Glam at 48 Arab Street, and was also recently awarded the master lease tender for state-owned properties at 159 Jalan Loyang Pasar. And meanwhile, its co-living projects at 453 Balestier Route, which has 34 keys, and 260 Upper Bukit Timah Route with about 62 keys are also likely to be operational in the third quarter. So coupled with the sale of its SOTA titled units at its 9-story food factory, we think that we are expecting a stronger second half earnings for LHN.
Okay. Now, there's been some discussions about LHN actually spinning off their co-living business. And now this is the business that's been doing really well for them. Can you talk us through what's happening there and what the progress is, and what actually will this mean for valuations?
Yeah, so LHN has announced that it proposed to spin off its co-living business pending shareholders and regulatory approvals. We understand that the group intends to retain a majority stake in Cordiwu upon completion of the internal restructuring, and therefore it will also continue to consolidate its financials post-listing. I think if the spin-off is successful, we believe that this will help to unlock the value of its existing portfolio and potentially re-rate the stock closer to its book value of about 63 cents.
Got it. Okay. Thanks, Eric. We got a buy on this stock, and I think there's quite a few catalysts here, and it remains a very interesting name to look at these levels. Now, before I go in and look at some of our trading ideas, I've got a question here from the audience asking, is the market less sensitive to Trump rhetoric on tariffs, given the de-escalation and market recovery and threats followed by extensions? Now, look, I think the market is kind of taking some of this in its stride, and that's what we saw. That's what we're seeing with some of the regional markets today as well. But I think the market and investors are getting more and more used to Trump's playbook. You know, come up with very, very high tariffs and massive threats, and then give pauses. But I think one thing is should be taken note of. We haven't seen any walkbacks in terms of tariffs. All we have seen so far is pauses in terms of tariffs. So I think that's something that is very, very important. And that's actually something that we need to keep an eye on. If Trump doesn't walk back on tariffs after these pauses, then we might actually end up on a brand new cycle of downside again. And if you look at the administration and the policy, so far they're very, very strong in terms of, and very, very focused on keeping these tariffs in place, because that is a fundamental playbook for this administration. So which is why I think you know, the mantra last year of actually going big on the US equities probably will not work as much and will be a much more volatile trade for this year. And you probably want to look at diversifying into global equities and particularly into safe haven markets like Singapore, but also some of the North Asian markets as well. Now, let's look at some of the trading ideas from our chart guy. We've got two ideas today. One is a trading buy on CIVMEC. It's on a verge of a bullish continuation breakout, says Amirul. So do have a look at that. And we also have a trading sell on YANLORD land. It appears that the price now is trading beneath all major moving averages, and that may actually drive this stock to be weaker in the near term. A lot more details on that in our newsletter today from Amirul. Now, with that, let's move on to Hussaini, who's got a brand new note out on Singtel. Now, Singtel has been one of the key beneficiaries of safe haven flows in Singapore, I think much more than even the banks this year. So, Hussaini, you say that Singtel is on a firm footing after the financial year 2025 results, yet you've actually cut earnings by about 11%. So how should we read into this?
Sure. Thanks, Ilan, for having me. And yes, we did cut our earnings estimates by 11% for Singtel, but that is mainly reflecting two things. First is that after the amalgamation of its Thailand associate InTouch with Gulf Energy, InTouch will no more be an associate. so its contribution is dropped. Second is Singtel recently sold 1% stake in Bharti. So we also cut our Bharti contribution in Singtel's earnings. So those were the two major ones. There were some minor adjustments like Telkomsel and some FX adjustments, but those were the two main factors driving cut in our earnings. Now, important to note is that despite we cutting earnings by 11%, we raised our DPS estimates, dividend estimates by 2%. So as such, we don't see that the earnings cut to have any bearing on the dividends.
Got it. Got it. So how is management positioning in terms of capital returns now? I mean, that has been one of the big themes for Singtel. What's the latest there?
Yeah, and that was one of the key highlights of the results which came out last week, is that management raised its capital recycling target from 6 billion Sing dollars to 9 billion Sing dollars. Now, management didn't went exactly into details of what drove the lift, but one of the areas they highlight is that the underlying asset value has gone up in the last 1 year or so, and that was one of the factors driving them raising the capital recycling from 6 to 9. Now, for instance, say Bharti Airtel, which they are looking to part sell, and if we look at the Bharti share price, it has re-rated 34% in the last 1 year itself. So net management is quite confident in terms of capital recycling. This in turn should allow for elevated capital return to the shareholders. So management announced a $2 billion share buyback on top of its regular dividends, as well as the so-called special dividend. They call it value realization dividend of 3 to 6 cents. So if we put all these things together, it translates to an attractive 5 to 6% dividend yield, and that is quite sustainable over the medium term. And we also get $2 billion of share buyback. So that in our view is very positive.
Got it. Now the stock has benefited from a lot of safe haven flows this year, mostly from institutional investors. Now, what will investors look for going forward if we were to sustain this trend?
Yeah, sure. So besides capital management, which is a big catalyst for the stock, we see some silver linings which could also help to further strengthen its earnings momentum. See, Optus for the last many years was a trouble for Singtel. It is turning around now, and it is turning around well. So in FY25 itself, we see EBIT for Optus was up 55%. Competition in Australia remains highly rational, and we expect a similar elevated momentum for Optus going forward. Telkomsel is another area of trouble for Singtel, Telkomsel in Indonesia. Now, we also see some silver lining in Indonesia as well, as competition after being elevated for the last 2 years. There are some silver linings that it is turning around. Now, if we put all these things into perspective, Singtel has eight businesses, we can call it, 4 core businesses and 4 associates. Of that 8 businesses, we are of the view that 5 are in a great shape right now. And one of them, which is Telkomsel, we see some turning around. So there is some silver lining. So net, the business remains in a very nice position. And we expect around 14% earnings growth CAGR for the company, which is very strong. So among the global telcos, if we see, it is hard to find any telco growing at such a pace and at the same time yielding 5 to 6% dividend yield.
Got it. Now, very quickly, you've done some very interesting work in the internet sector, and you've launched a very interesting alternative data series called the On-Demand Service Meter. Can you very quickly catch us up on what this is and what you're seeing for its latest data in May?
Yeah, sure. So what we do is that we keep track of the ride-hailing pricing as well as food delivery pricing in Singapore and Indonesia. In Singapore, we track it thrice a day and across multiple locations. So and it helps us to gauge where the pricing is moving, going up or down, and what individual operators are doing. So for May, we find two interesting trends. First is that pricing is stable to improving. So in Indonesia, the four-wheeler pricing has increased by almost 13 to 23% compared to what it was at the start of the year. And two-wheeler pricing is also going up in Indonesia. In Singapore, we see that Tada and Gojek prices have increased by almost 14% and 99% respectively. Food pricing to an extent is relatively stable. So the first observation is that competition or the pricing has been stable to going up. Second observation is that Grab services are becoming more and more affordable. Now, if we compare to Grab's pricing to that of its competitors, in Indonesia, Grab pricing compared to Gojek is a 13% discount on the four-wheeler side. It is a discount on the two-wheeler side as well. In Singapore, where Grab is considered one of the very quality operators, its pricing is in fact 8% discount to Gojek and only 2% premium to Tada. Now, if we go say last year or so, Grab's pricing was at almost 10% premium to Tada or more than that. So we see that Grab's pricing has become more and more affordable. And we don't think that Grab is more competitive in the market. The affordability of Grab pricing is mostly driven by its bigger scale, its better execution, as well as leveraging technologies like AI. So we are of the view that Grab, although the Grab pricing or services is becoming more and more affordable, we are of the view that it is not going to come at the cost of margins.
Got it. And I just want to remind Husseini has buys on both Grab as well as Gojek as well. We're running short of time, but there's a very interesting question here from SC Tan who's asking, do you think the theory of sell in May and go away in June will hold in 2025? I honestly don't think so, simply because if you think about the next month or so, you got Trump's tariff moratoriums, a 90-day moratorium coming to an end early July. So we do expect quite a few announcements to happen in June in terms of fresh tariff levels for quite a few countries. So I think, yeah, as these deals are reached, you're going to see markets reacting to that. And you may actually see, particularly in some of the ASEAN markets, whether it's Vietnam, Indonesia, and so on, you may have tariff differentials emerging, and that'll have an impact in terms of where the markets go. So I think the volatility, at least in the near term, and that's just on the 90-day moratorium. You still have the semiconductor tariffs, the pharmaceutical tariffs, the EU negotiations. So many moving parts taking place over the next month or so that markets will remain fairly volatile. So whether you're a longer term investor who's looking for cheap entry points, or for traders, I think it'll be quite a bit of an action-packed month coming through. In terms of events, we've got on the 27th of May, we've got IREIT Global coming up. So do sign up for that. And also in terms of macro, we have industrial production out on the 26th of May. The bank lending numbers are coming out on the 30th. And the PMI readings, which is something that we'll be watching very closely for in terms of front loading during this trade war, coming out on the 3rd of June. With that, unfortunately, we are out of time. Thank you so much for joining us. We'll see you next week. Have a profitable trading week.